Remember the old Almond Joy commercials?
Sometimes you feel like a nut, sometimes you don't. Almond Joy's got nuts, mounds don't.
No, not the nut ones, but the ones that went, you could share half and still have a whole. In this video, I'll cover how sharing half of stock market gains can be a really sweet deal. One of the most popular conservative investments available is an FIA, a fixed indexed annuity. Now, the interest credited to these products is often based on the performance of some external equity index. However, since your dollars are never invested directly in the market, you won't lose when the market falls. Now, there are several ways to determine your annual earnings on the account: caps, spreads, and for this video, participation rates. Now, participation rates means that your accounts receive a percentage of the market gains when the market goes up, but neither gains nor losses when the market falls. In this example, I will assume that you might have invested $100,000 in the S&P on January 1st of 2005. 10 years later, your investment would have grown to $169,884. However, as you can see from the graph, it was a pretty bumpy ride. So, what would have happened if you would have invested the same dollars in an FIA with a 50% participation rate beginning at the same time? As you can see from the chart, the first year the market returned 15.59%, of which your account earned half. The next 2 years were essentially flat, but look at what happened when the financial crisis hit in 2008 and 2009. When the market plummeted, you didn't gain anything, but you also didn't lose. Your balance remained the same. Your gains were locked in at the previous year's values. At the end of 10 years, your account would have been $169,869. A line graph of the two strategies shows the power of avoiding large losses. The red line is the S&P and the blue line is the annuity. Now, even though you only earned half of the gains, by avoiding the big losses in 2008 and 2009, you ended up in essentially the same place as if you were investing in the stock market. Naturally, I don't have a crystal ball to predict what will happen in the future. And usually, investing in the stock market will generate a bigger return than investing in an annuity. And as with all investments, there are strings attached, and they aren't for everyone. Now, that said, an FIA may be a viable option for the conservative portion of your portfolio, possibly as a substitute for bonds or CDs. I work to create client portfolios that participate in market gains while protecting against large market losses. My goal is to help you retire happily ever after. Call today at 480-503-0050 for a complimentary appointment.
This has been a Loki production.